It was a quiet day in the United States stock market with the S&P 500 advancing just 0.1%. However, that muted response really didn't tell the whole story. Last night we heard from the Bank of Japan that they were raising their interest rate band on their 10-year treasuries, and that was not something the market was anticipating, and the futures market initially sold off aggressively upon that news. So the fact that we recovered all those losses overnight and actually closed in the green today was a little bit more promising than you would have expected. Nonetheless, we've of course suffered some huge losses in the stock market in the last week or so, so maybe we're just seeing a little bit of calm before a continued storm here in coming weeks and months. So we'll review all of that and see what it means for our postures across the various markets out there. Then we'll get into our trade application example, where I wanted to finally focus a little bit more energy on the gold market. We've been talking about it for quite some time now, but I'm actually going to put that to work with a bullish trade example on a gold mining stock. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's December 20th, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into the description area. Make sure you're signed up for our email distribution list, so that way you can be notified whenever we post these videos. You'll also find which stocks are giving you overbought and oversold cluster signals within the S&P 500 at the bottom of those emails. In addition to that, we're heavy users of Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee. And we really appreciate those of you that click like and retweet on those Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And as you can see, I've got the S&P 500 heat map pulled up here in front of us. And for the most part, it actually turned out to be a reasonably good day for the bulls, which if you were following the futures last night, that probably would not have been the expectation. A lot of news coming out of Japan. Some of you saw me tweeting about the Japanese banks as an example here today, benefiting from the Bank of Japan's, the central bank over there, their decision to allow 10-year yields to rise above kind of the band that they had been used to in previous years. Of course, Japanese yen, most known for as a carry trade type of a situation where cheaper money becomes available as their recorded inflation tends to be a lot less than what we're experiencing over here in our neck of the woods. Nonetheless, markets did recover from those sell-offs that we saw in the overnight session, and we actually closed a little bit in the green here today. So that was a little bit of a surprise, and it's kind of why they play the game, right? For those of you that are NFL fans, you may have watched the Minnesota Vikings versus Indianapolis Colts game on Saturday, and if you turned the game off at halftime, I wouldn't have been too surprised, considering the Colts were up 33-0. The assumption is, of course, that the Colts would end up winning that game. After all, no team had ever surmounted a loss like that at halftime, where they were losing by that much at halftime and ended up winning the game. Well, wouldn't you know, records are meant to be broken. And here come Justin Jefferson and Dalvin Cook and the rest of the Minnesota Vikings and actually end up winning that game, the biggest comeback in NFL history, dating back decades and decades and decades. So again, that's why they play the game in sports, and that's why we got to play the game in the financial markets as well. We can have our assumptions about how the markets will react to a certain set of news, but until we actually see it with our own two eyes, we cannot confirm it. So I think today ended up being a little bit surprising. Now again, it wasn't a huge up day, so we don't want to make too much out of it at the same time. But nonetheless, the fact that the bulls are still around after getting kind of kicked in the teeth last week does at least send a little bit of a signal. So as you can see here, we did end up having more green on the board than red. There is one red square that stands out more than any other, at least to my eye, and that is Tesla. Boy, oh boy, that stock just cannot get out of its own way. It was down another 8% here today on rumors about, is Elon Musk selling more of his Tesla shares? Is he, meeting a margin call? Does he need to sell shares in order to finance his Twitter acquisition? Or is the market just starting to collapse because we are seeing things like the ARK Innovation Fund, of course, that became famous as a result of their early call on Tesla. ARK is now trading at its 5-year lows. They're trading all the way back to where they were in 2017. So a lot of the companies that Cathie Wood and company own, like a Tesla, probably going to get hit a little bit more than the rest of the market, as that particular fund has just been in a one-way trajectory to the downside. And of course, there's still a lot of people that are upset with Elon Musk spending as much time as he does at his newfound love of Twitter, as opposed to being the CEO over at Tesla, where maybe he could be a little bit more productive. And in fact, there was a poll that he conducted on Twitter over the weekend saying, do you guys think I should continue as CEO of Twitter or not? And I think it was 57% of those that responded to the poll said, nope, we want you to go. So we'll see if he abides by that or not. But a lot of controversy these days with Elon Musk, Twitter, and Tesla shareholders are certainly suffering as a result of that, down 8% today, on track for what they said on CNBC today, which would be their worst month in their history. Now remember, Tesla is not like Procter & Gamble or something like that that's been around for 100 years, so they don't have the most extended history out there of all the stocks that we cover. But they've been around long enough, and it is somewhat noteworthy that this is the worst month in public history for Tesla shareholders. It's also going to end up being the worst year in history for Tesla shareholders. So at some point, there's going to be a lot of questions asked about this whole transition with Elon Musk spending as much time as he does over at Twitter. But anyway, Tesla remains in a downtrend. You don't need me to tell you that. In fact, the last time we've taken a trade on Tesla in my classes was a short selling trade. And of course, that one worked out nicely for us. So where it'll eventually bottom out is anybody's guess, right? For years and years and years, we were just amazed on the sidelines watching Tesla shares skyrocket day after day, week after week, month after month, wondering how in the world could this one company be worth more than the entire rest of the automotive industry. Remember, there were actually statistics like that where Tesla's market cap was bigger than, Toyota and Ford and GM and all these other companies combined. And that, of course, doesn't make a whole lot of sense. We're now seeing the flip side of that argument, where things are becoming a little bit more rational once again, and that excess is now being corrected out of the situation. So is Tesla a dying company? Probably not. I'm sure we'll still see plenty of Teslas driving around on the roads here in the next 5 years plus. But, what happens with the stock along the way is anybody's guess. And what we've known for quite some time is that it's been a very overvalued stock. And at some point, the pendulum may very well swing too far, and maybe it'll become an undervalued stock. But along the way, there's going to be some pretty aggressive trading, because that type of a stock, a speculative stock like that is an innovative, disruptive company that doesn't pay a dividend, that's the type of thing that attracts a more aggressive and speculative trader, and therefore you do see wilder swings with that type of a company. So that one certainly stands out here amongst all of these different companies in the S&P 500 today. There were plenty of other companies that were down. A number of the healthcare companies were down a touch here today, as you can see. A lot of the REITs were down today. In fact, we talked about REITs in my dividend growth investing class today. We kind of wrapped up our year, since next week David and I will be off between Christmas and New Year's. So that was our final dividend growth investing class of the year. If you are a premium member, of course, I do have that posted on our events calendar already, and you're welcome to go and check out the recording. And of course, first week of January, we'll get right back at it once again and start our process all over and looking for new opportunities as 2023 unfolds before us. So looking forward to that with many of you as well. So those are some of the areas that were kind of out of favor here today. In terms of some of the areas that were in favor, I would say energy seemed to have a pretty good day. Notice all that green kind of, sitting right there there in that ExxonMobil, Chevron, Conoco area. So I think energy had a pretty solid day. It looks like we probably had a pretty decent day there in communications with Google. Up here today, Disney actually had a rebound. Disney actually broke to multi-year lows yesterday, but then kind of bounced back from that here today. Similar to Tesla, the last time we've traded Disney in my classes was a short selling opportunity that I presented in our factor-based swing trading class a few weeks ago, and that one would have gone to max gain. It didn't end up getting voted for. A different trade did in the end, but those of you that may have taken that Disney trade, despite what looked like it was going to be a challenging setup for us after I presented it, because it was right before Bob Iger came back, but because of where we had our stop loss, we still would not have been stopped out, and yesterday you would have made it to your max gain. So congratulations to any of you who took that trade there as well. But today, a lot of those communication stocks did have a little bit of a snapback rally there. Looks like we had some strength in the industrials area as well. A lot of those defense contracting companies, Raytheon, Lockheed Martin, General Dynamics, those have been some of the better stocks in the market for the full calendar year of 2022, mostly due to, of course, the conflict with Russia and Ukraine. But for those of you that have been paying attention here recently, you might have noticed that Boeing has really picked up steam. Earlier this year, they were approaching $100 per share in the market sell-off, and you can see now Boeing is all the way back up to $188. So all of a sudden, they are getting a little bit of traction there as well. A lot of people, they don't follow the industry all that closely, might not be aware that Boeing is a defense contracting company as well. Of course, we all recognize Boeing as providing commercial aerospace equipment and airplanes and things that we all fly around in as customers of United and Delta and Southwest and all that. But Boeing actually has about half of their business that comes from the U.S. military as well. So they're not a pure defense contracting company the way that Raytheon and Lockheed Martin would be. They're about a 50-50 type of a split there. Nonetheless, maybe they're getting some benefit that the others have had this year previous to this as well. Also notice a number of the financials doing pretty well here today. A lot of the insurance companies seem to be holding up quite well in this calendar year 2022 as well. And you can see a stock like Chubb is up 1.3% here today. Travelers was up, Allstate was up, Aflac was up. So that's another area to kind of keep your eye on there as well. After hours, we did have a couple of big earnings announcements that came out. So let's go ahead and pop on over here to the platform. In fact, this I'm still working through my dilemma here right now. Some of you that follow me on Twitter will know the controversy I'm going through right now with FedEx and my experience with Thinkorswim. Sadly, it is not going to work out in my favor, but I actually had an order out there to try to get filled with a buy order at $153.30. Reason I chose that level is that's where this stock would have a 3% dividend yield. And you can see right here on the chart in the after-hour session, it actually went down to $153 even. So once I saw that, I'm like, okay, here we go. Go to check the fill, and guess what? There is no fill. So I'm thinking, okay, what in the world is going on here? This has actually happened a couple of times in my trading history. Keep in mind, I've been at this for over 23 years, so if it's happened, it's probably happened to me. But anyway, I knew going into it, I probably was going to not be able to get my way with this deal, but nonetheless, I tried because, sometimes things are missed or there's glitches in the system or what have you, and the broker will be nice to you and give you your fill on your order if you were indeed, deserving of it. In other words, entitled to it because you had set up your order the right way. And I did do an after hours order. This is actually a good till cancel extended order on Thinkorswim at $153.30. And the stock went down 30 cents more than where I was willing to buy it, yet I did not get filled. So anyway, I took a screenshot of the time and sales. That's what I posted to Twitter for those of you that have been kind of following along with it. And I showed them right there. I'm like, hey, there were, hundreds of shares that were traded at $153 even. Why did I not get my fill at $153.30? And so they reviewed it for me, researched it as I assumed they would. And they came back and said that it was as a result result of intermarket sweeps that were taking place between brokerages, and that clients publicly are not available to get their orders filled at that price. And that was a little bit of a disappointment to me because, of course, you can now see that FedEx, after touching $153 after hours, has rallied all the way above $170 here. It is now up over 10% from where I thought I had bought it. And that means that I am missing out on over $1,000 worth of profits that I thought I had. Now, it's not that $1,000 is going to change my life. Obviously, I'm going to wake up tomorrow the same way I woke up today. But I think we can all agree that if you opened up your front door and you saw $1,000 sitting there at the base of your door and you reached out to grab it and then the wind picks it up and blows it down the neighborhood, that would be a little bit frustrating to you. So anyway, I'm trying to approach this calmly because I know every brokerage has their rules, but the frustrating part about it for me was that we as clients cannot see which trades are done as intermarket sweeps and which trades are done as publicly available trades. They're all kind of structured together in the time and sales area of the Thinkorswim platform. So that sets up a situation where we as clients have to just simply trust that the broker is doing the right thing for us. And that's, of course, a difficult thing for a lot of folks, just to trust that if we can't actually see it with our own two eyes. So I asked them about that when I inquired about the trade, and they said, yeah, anytime you need to verify that, just let us know and we can look at it for you. And I'm like, yeah, but I kind of want to see that myself because I don't want to have to trust you because you are the one that ends up in the better in this situation, and I am the one that ends up in the worse. So you can understand how it would be a lot better if the clients could actually confirm that information for themselves. So anyway, I've had a heated afternoon, and again, I have nothing against the particular customer service rep I was working with. I actually like Thinkorswim a lot. As you guys know, if I didn't like them, I wouldn't keep on using them. And I imagine I'll continue to use them despite this negative outcome from my perspective. But it is unfortunate that that does shake out that way sometimes. And so always do your best to try to stick up for yourself in your trades. And if you ever feel like you've been wronged by your broker, make sure you inquire with them and make sure you get, an adequate response. What was also funny about it is, when I was asking them more about this intermarket sweep situation, because I didn't fully understand it as a retail trader, and it wasn't something I had dealt with previously in my life working in the financial industry. So they actually forwarded me an article, and wouldn't you know, they forwarded me an article from Interactive Brokers, one of the competitors to Thinkorswim and TD Ameritrade. Many of you may know that David and I used to work at TD Ameritrade. It's been 5 years now, so we don't have any personal or any formal relationship with them any longer, right? Once upon a time we were employed by them, but it's been 5 years since that was the case. And today we just simply use their platform as the way that all of you use the platform, which is as a client of theirs. And so anyway, it was a frustrating afternoon, to say the least, when I went through all that information and still ended up on the outside looking in. So anyway, if that's ever happened to you before, I've seen a few other people on Twitter responding to it saying, yeah, it's good to know I'm not alone in that regard. So sometimes, there's company in all of us that have been felt like we've been wronged or something like that. And again, I imagine that they are completely right in this case. So it's just that it's tough to accept when you're on the other side of that argument, and there's no way that you can actually confirm it with your own two eyes without asking them to confirm it for you. So if you've ever felt like you've missed out on a trade by a few pennies here and there, and it would have made a big difference for you, know that you're not alone. Misery loves company, so I'm right there with you. Anyway, I suppose this is good news for the market at large now that I can move past my grumbling for a moment, because FedEx, of course, is a big bellwether stock in the industrial sector, and with that stock performing quite well after hours now, that could very well bode well for futures trading and as we head into tomorrow morning. Now, speaking of stocks reporting earnings after hours, FedEx actually wasn't the biggest mover. It was actually Nike, another very important company, a bellwether type of a stock, this time, of course, in the consumer discretionary space, but it does kind of give us some insight as to what's happening with with the consumer globally, of course, because Nike is such an important company, not just here in the United States, but all across the globe. And of course, all eyes were on Nike as we've had, all that NFL football action that I had mentioned, on top of what an outstanding World Cup victory. And congratulations to those of you that might support Argentina, and hearts out to all of you out in France. It was a tough loss there, but what a great game for everybody to watch globally there. And of course, Nike was right there front and center, as so many athletic apparel companies would be. So you can see Nike closed today's session at 103.21, up just barely today. So participants were kind of going into the earnings print with no expectations in either direction, bullish or bearish, basically flat on the day. But after the earnings came out in the after-hours session, you can now see it's trading all the way up to $116 here as we speak. So, up about $13 per share. That's a 10% move there in Nike, and that could very well help support some of those areas like consumer discretionary and retail as we head into tomorrow morning's open as well. So those are the only two big ones to discuss here in the after-hours session tonight. Remember, we're really past the major hump of earnings results that were out there. Most of those were done a month ago. These are kind of some of the stragglers that are out there. And I imagine that most of our activity here in the coming week and a half or so as we close out 2022 will be somewhat calm. There's not any major economic releases that we're expecting, and most earnings have already been reported. So can we still get volatility? Of course. Sometimes volatility is encouraged when there are fewer participants in the market, and one thing that happens around the holidays is a lot of Wall Street firms will take that time off, right? David and I are, of course, taking time off next week, and we're not alone. I know, Motley Fool and so many of these other types of investment and education types of companies kind of go dark that final week as well. So that means that there's probably a lot of people that are unplugged from the market. In my case, I know my family and I are going to try to take maybe a 3, 4, 5 day road trip or something like that, so I won't be as plugged in as normal, and I'm sure I'm not alone. A lot of people busy with the holidays, busy with friends and family, probably not paying attention to the markets quite as much, and if there's less people participating, there's a greater opportunity for those that are participating to kind of push the market around a little bit more. Remember that normally during the holiday period, it's pretty calm, and there's usually a grind higher into the year end. But we did have that 1 year in 2018 where the stock market was just careening into Christmas Eve. And so there is always that possibility that that could be repeated here as we move forward in this difficult year of 2022 as well. Remember what I've been mentioning here for a couple of months at this point, that when we have a year like this where we've had more turbulence and more aggressive selling in the market, where people are sitting on a lot of losses in their portfolio, they might choose to liquidate some of those holdings in order to create a taxable event where they can start offsetting some of their gains over the years with some losses that they're experiencing this year. And so a lot of times when we have these difficult years, you see a little bit more selling into December, when normally when you have an up year for the market, you see more buying in December. So be on the lookout for that possibility there as well. But so far so good here tonight with both FedEx and Nike rebounding and jumping higher in the after-hours session as a result of their earnings. Let's go ahead and take a look at our breadth numbers now, and you can see here as I pull up the S&P 500, it was a pretty split day, all things considered. We had 267 stocks that closed higher, 232 closing lower. So that was good for about a 53% win rate from the bulls there today. So it did support the fact that we did have a positive end result, right? When we look at the S&P 500 now, you can see that it was up 0.1%, so a pretty modest day, all things considered, especially after suffering a 4-day sell-off. If this is the bounce that you're getting, that's not much of one. That's more of a whimper right there. Nonetheless, it does go to show that what we witnessed there on the heat map does make some sense, because it seemed like there were more stocks that were up than were down, and we do see at the end result today, despite that what seemed to be negative news story out of Japan last night, ended up with slight gains here in the United States when it was all said and done. However, just because the S&P 500 was up 0.1% here today did not stop the posture on the S&P 500 from going to a strongly bearish posture. Notice that this color background changed when from this kind of light pink to this dark pink. And that occurs when this green line, the intermediate line, which we kind of use as our default posture setting mechanism here in these videos, unless you hear us state otherwise. Because remember, the other lines have their postures as well. And if we're ever talking about their other postures, we'll be sure to elaborate that that is what we are referring to. If you just hear us say posture in general, then what we are referring to is this green intermediate line here on the market forecast. And when that starts slipping, we give it a little bit of leeway until it gets to the midpoint of the indicator at the 50th percentile. So that's why it's kind of that light pink. It's telling you to look out. You know, things are starting to get a little bit chaotic, a little bit hectic. And then once that green line slips below the 50th percentile, then it really means business, where, hey, this is getting to be a much more serious event here that we want to be more aware of as traders. So we have now gone to that strongly bearish posture according to the market forecast technical indicator on the S&P 500, and they weren't alone. You'll see over here to the right that the Dow Jones Industrial Average did the exact same thing. They are now with a strongly bearish posture for the same reason. The green line had already rolled out of the upper reversal zone on the Dow Jones probably a couple of weeks ago. About right there is when that happened, the first week of December. So we've already known that there's been some, bearishness infiltrating the system. It just hasn't been as persistent as it became last week. Once last week happened and we had that 4-day sell-off, then this green line really started to slip from those upper echelons and has now crossed into the lower half of the market forecast indicator. So we've gone from light pink to dark pink on Dow Jones Industrial Average as well. The Dow, by the way, was up 0.28% today. The bottom two charts are a little bit different, mostly because they've already been more bearish, right? We talked about that last week when I was with you as well. Right? We've talked about how it wasn't a huge surprise to see the S&P roll over because it had rolled over right at that 4,100 level where we were kind of expecting it to, where it was, banging its head up against the underside of that falling trend line that we laid over the tops of the highs of the S&P 500 this full calendar year. So it's not a surprise that we found this bearishness, but every index moves kind of to the beat of its own drum, right? A lot of times you see that they move kind of together, but they move together at different degrees. And what we have been noticing out of the market here in recent months is that the Dow Jones Industrial Average has been the one that's been the most resilient and has been the most bullish when the markets were bullish. So the other indices were kind of vying for which of them were the laggards. And as time went along, the S&P 500 started to kind of identify itself alongside the Dow Jones as being a little bit stronger, and it was our two bottom charts that were struggling the most. That's the NASDAQ composite, where, of course, you're going to see Tesla as a big component of that NASDAQ. The more speculative, technology-oriented types of companies are oftentimes housed at the NASDAQ composite. And then you have your speculative small-cap companies housed with the Russell 2000. And as I mentioned last week and the week before, in the factor selector tool, the low size factor has been the laggard from a factor perspective, and that aligns itself nicely with the fact that the Russell 2000 is clearly lagging the mega caps of the Dow Jones Industrial Average up above it. So all that kind of stuff should not come as a surprise to those of you that have been listening to David and I for the last several weeks. It is basically confirming what we've already been seeing. But these two areas down below have been more bearish, and therefore it shouldn't be a surprise to know that they went to their strongly bearish posture before the two up at the top. The S&P 500 and the Dow Jones Industrial Average just did that today. The two on the bottom, in the case of the NASDAQ, it happened yesterday. And on the case of the Russell 2000, it actually went to strongly bearish posture back here on December 15th, so last week. So you can kind of use that to determine, well, which areas are leading and lagging. To my eye, it does seem like the Russell 2000 is our laggard. Not only did it go to a strongly bearish posture before all the rest of the indices? But what we know about the factor selector and the low size factor not participating right now, largely because the dollar is no longer favoring them the way that they were earlier in the year, in addition to looking at things like the intermediate line number itself, right? You can look at the labels within this chart setup to identify the fact that, up here you see the Dow Jones Industrial Average is at the 42.5 position on the market forecast indicator. It's falling, but it's at 42.5, and that's the highest of all 4 of these charts we see in front of us. The Russell 2000 at 15.23 is the lowest of all of them that we see in front of us. So that's another dead giveaway as to why the Russell 2000 seems to be the laggard in this current marketplace. Strangely enough, it actually led the markets today, so perhaps there's a little bit of a dead cat bounce phenomenon going on there on a one-day basis, but as we always say, one day does not make a trend. But it was up, to be fair, 0.54% today, so a little bit more of a snapback there than what we saw at the NASDAQ, which is basically flat today. It closed up by 0.01%. So if you thought that the 0.1% move higher on the S&P 500 was a sleepy move, 0.01% is about as close as you can get as a flat as a pancake type of a performance out of the NASDAQ composite here today. So that's the takeaway. All of these charts remain bearish. The new information is that all of them now are considered strongly bearish, whereas some of them were weakly bearish as of last week. So today we got more confirmation, despite slight bounces in the market, that the bears are still ruling the roost after seeing such an excessive sell-off last week after the FOMC meeting. Let's go ahead and pop on over here to the internet briefly. I always like to get a chance to say thank you to those of you that help support these free videos that you find from David and I here on YouTube and elsewhere. Remember, it takes up a considerable amount of time for us to do these videos. At least 3 hours of our day is dedicated to the research that goes into it, the placing of the trades while the market is open, the prepping for the information for the presentation itself, actually delivering the presentation, going back and editing the presentation where necessary, writing up this paragraph of information for our website, in addition to uploading all of that information to YouTube, also sending out the emails and the notifications on social media, and we don't have a staff. It's just David and I doing that, right? So if you appreciate all the work that goes into this, we ask one very, very simple request out of you. Click like for us on Twitter. For most of you, that's not a very hard thing to do. For some of you, perhaps it is, and I understand there are various reasons why maybe you aren't able to do that. But remember, Twitter is free, so if you choose not to be on there, that's your decision, and that's okay as well. But for all of you that are listening to this right now, clearly you're on the internet and it's working properly, so you have every ability as anybody else to be on Twitter if you wanted to help support us. Fortunately, we do have a very loyal group of people who will do that for us regularly, and I'm thankful to say that once again, you guys came through in the clutch for me. 113 of you clicked like. As I always say, as long as we're up and over 100 likes, I'm more than happy to do a full-length video there for you to make sure that it's kind of worth my time, my 3 hours of the day. If nobody really cares what I'm saying and I'm just talking into the wind, then I don't need to put as much time and energy into this at the same time either. So that's your best way to help support David and I, is just simply clicking a button for free. And most of you can do it in under 5 seconds. So thank you to all of you who did that for me last time. And again, as long as we're up and over 100 likes, by the time I'm scheduled to do this video this upcoming Thursday, I'll give you another full-length video just like this one, where I go through additional analysis with the 12 grid video, or the 12 grids on the charts, and then also give you a nice trade application example to kind of take away from the presentation. If you would prefer the streamlined 15-minute version of the video where I don't supply a trade application example and go through additional charts, then don't click like, because if we're under 100 likes, then I'll just plan on doing a very short video for you there on Thursday. But again, remember, Thursday is going to be the last time you hear from me this year, because I'm going to be out of town, out of cahoots next week, and so that will be my last chance to work with many of you on the free product here on YouTube. So if you want to hear from me at length on Thursday, click like. If you don't, then don't click like. But thank you to all of you regardless for checking out the video here tonight. Also, Of course, we've had lots of great activity here at Market Scholars. Earlier today, I taught my dividend growth investing class, as I had mentioned to you previously, where we focused on the real estate sector. That's one area that's really been beaten up here recently. And of course, as dividend growth investors, we're interested in stocks that have gone down in price, not the ones that have gone up to all-time highs. And so we become more interested when stocks fall because of the inverse relationship between dividend yield and price. When stocks prices are falling, as long as we can trust that the dividend won't be cut, then it becomes a more seductive opportunity to buy a stock that we think highly of when it is on sale and its dividend yield is higher. So if you're interested in that conversation, we did look at a couple of REITs today that, to my recollection, we had not talked about previously. And if we had, it probably would have been only one time in the last 5+ years. So something new, and that is the nice thing about chaotic years like this, is that some stocks fall way further past where they probably deserve to fall and show up on our laps when, times are more exaggerated and there's more extremes in the market like there has been in 2022. So feel free to check that out on the recording if you're a premium member. And as I mentioned before, looking forward to starting the dividend growth investing class again with all of you, including those of you that joined us for our Black Friday sale the first week of January, where you can kind of see that whole process right from the start, which is kind of fun to build things up from the beginning as a group, as we do in my classes. Anyway, let's take a look at the sector selector here now. A reminder that the sector selector gets put together on Friday evenings. It was quite late by the time I finally got it posted, but for those of you that are premium members, remember that I do send out a quick little heads up on our Telegram channel to let you know when it's available, so that way you don't have to just keep coming to the website and hitting refresh over and over again. Some of this data that goes into these tools, this one and the stock selector tool that I do on Friday nights, requires a little bit more of an effort than may be apparent to you. So sometimes I don't get that information until later than I would prefer as well. So thanks for bearing with me on those weekends where this doesn't get updated until really late on a Friday night. Nonetheless, you still got Saturday and Sunday to sink your teeth into it before we get into our classes traditionally on Monday morning. So let's talk it through. You can see that healthcare did stay up at the top for the second straight week, and I was kind of curious about that. As I had mentioned last week when we reviewed this, it's almost like there's like the John Madden curse. For those of you that play the Madden video game, I'm not a big video gamer myself, but I know of the curse. Like if there's a player that ends up on the cover of the Madden video game, then that player oftentimes has a very bad year the next year. And sometimes you see that in the world of finance as well. Remember, there's been some very famous covers of magazines out there, like The Death of Equities that happened several decades ago, right before we had a monstrous bull market. Or another one that comes to mind is the Facebook cover on Barron's. And Barron's did not like Facebook at that time, and they had the thumbs down sign. And little did they know that Facebook was eventually going to become part of the epic FANG trade for the next several years and go up hundreds of %. Of course, now we're seeing the reverse of that in 2022. But the point being, sometimes it feels like there's a hex on you if you're at the top of your game and there's a target on your back. Well, the last couple of weeks, you can see that industrials overtook energy as the number one sector, only to be usurped the very next week by consumer discretionary, but they only stayed up there for 1 week as well, and then were replaced by healthcare. But they finally break the pattern here because healthcare was able to retain the strength enough to stay up there for the second straight week. And like I mentioned to my students on Monday morning, we did also see that consumer staples made their way up a notch, in addition to seeing utilities making their way up, 2 or 3 notches in that case. Remember, healthcare, staples, and utilities are what we would identify as being defensive sectors. So when you see those sectors rising in the rankings of a relative strength tool like this, that's generally not a positive sign for the overall stock market. As I've mentioned to you guys here in these videos in the past and also in my classes, if I had it my way and I wanted just a rip-roaring bull market to the upside where there was lots of alpha availability out there for all types of traders, what my preference would be to have discretionary, technology, and communications leading the way, because that's where you find those FANG stocks that have kind of those compound growth characteristics. But notice that all three of those areas, discretionary, technology, and communications, all went down multiple rankings week over week. So we are seeing basically the exact opposite of what we would want to see in a healthy bull market environment. We're seeing the defensive sectors rising, and we're seeing the growth compounders falling. So not a great look there, and it kind of confirms what we already knew after looking at price activity last week on the S&P 500. This is still a market that seems to be possessed by the bears more so than the bulls. All right, let's go ahead and get back on over here to the charts, and let's do some 12 grid analysis, starting with chart 5A. This is our asset class 12 grid. And as we're pulling this up here, a reminder that the background colors will be associated with whatever the posture is for those symbols represented in the charts. And the postures, once again, as mentioned before, will be set by what the green line is doing on the market forecast technical indicator. For those of you that are premium members of Market Scholars, remember we do have shared links that we can offer you with a lot of these different charts that you see us using. And with these 12 grids, just a friendly reminder that if you do right-click on one of them and go to maximize cell in the submenu, you can then see it on a full screen view, and then you actually see the market forecast technical indicator down below. So like when you have this pink background color on EEM, that's because, as you can see, that green line has rolled out of the upper reversal zone and is now trending lower. It hasn't quite gotten to the 50th percentile, so that's why the background color is not dark pink. Nonetheless, it's heading in that direction. Whereas when we go to the normal 12 grid view, you can't actually see the market forecast indicator down there, because apparently that's just how Thinkorswim handles it. When there's too much information trying to be displayed on miniature charts like this, they can't show you everything. So you have to kind of zoom in or maximize it in order to see that information. So that's why the background colors become more effective. You don't actually have to look at the market forecast technical indicator if you don't want to. You can just understand what the colors are telling you to understand what the posture is. So let's go ahead and get started with the conversation in the two lower corners, as we have pretty much all year long when I've been going through this information with you, because those have been really the stories for me of the year, what's going on with the dollar and what's going on with the 10-year Treasury yield. So let's go ahead and get started in the lower right-hand corner here with the 10-year Treasury yield. We actually had a pretty strong day for interest rates. They started popping pretty aggressively, and it wasn't just today. I'm sure David probably mentioned this to you in his video last night as well, but we had a pretty strong move yesterday in interest rates. Last week, we were below 3.5% on the 10-year, and that was after Jerome Powell had made his interest rate decision. So that was a little bit strange, right? And as I mentioned to you guys on Thursday, remember that the long end of the curve is not controlled by Jerome Powell. He can have some indirect influence on it, but not direct influence the way that he can on the short end of the curve. So it was a little bit strange that the market was trying to kind of almost call his bluff last week. Well, now we're starting to see that maybe the market isn't prepared to fully call the bluff, because now you can see interest rates rising back to those higher levels and kind of responding to the fact that Jerome Powell is not done raising rates yet. And so last week we were down there at 3.5% on the 10-year. Today we find ourselves all the way back up to 3.68%. So kind of amazing how quickly things can change in just 2 days worth of time right there. However, not all hope is lost, because as you can see, with interest rates popping the last couple of days, they've now found themselves just on the underside of this falling 30-day moving average. And so who knows, maybe there will be some technicians selling for technical analysis reasons, selling yields, in other words, buying bonds. But I don't know how much I buy into that, because it's not your typical type of a trade that is fully controlled by just the traders. As I mentioned before, there's a lot of other elements at play, including what's happening with the Federal Reserve. So it makes it a little bit trickier from that regard. Nonetheless, be aware interest rates have been rising pretty aggressively just the last 2 days, but do still remain in that bearish posture and basically sitting right at the downtrending 30-day moving average. Now, when interest rates are up, remember the opposite happens to bond prices. So if we direct our attention now to the middle rung off to the left, that's TLT, which represents our long-term U.S. Treasuries. And as you can see, Treasuries have sold off for the last couple of days. So when interest rates go up, bond prices go down. And notice the exact opposite phenomenon with the posture as well. Whereas we have been trading above a rising moving average on long-term treasuries and still retain our bullish intermediate posture, it's the opposite for interest rates. Interest rates have been falling below their falling 30-day moving average and retain their strongly bearish posture for the time being, despite the move against those primary trends in just the last couple of days. So we shall see, but this would be probably an area for those of you that have felt like you've been on the outside looking in and wondering when long-term treasuries will finally give you a pullback, because this was a very aggressive move on TLT. Of course, we were talking about it back here because of how aggressive it was to the downside. Remember, that was at a time when I was selling puts on TLT, so we were talking about it quite regularly. And I kept on saying, well, we've got to find a bottom here eventually. Well, we eventually did. Eventually, we saw a TLT rip higher, even higher than I expected it to, quite frankly. Now we're seeing the give back of some of that move here. Now you're at a little bit more of a rational pricing for long-term bonds for those of you that felt like this was too hot to handle in this move over here. Now you might be a little bit more convinced that if you got some room in your portfolio for exposure to long-term bonds, this would seem to be a more logical place price-wise to do that. Not to say that you couldn't find even more logical prices moving forward, because a lot of people do expect interest rates to keep on going up, but a lot of people, the way they handle the bond market is not all in and all out all at once, right? They kind of pepper their way into their positions, and piecemeal it a little bit more so, as opposed to just making one huge decision for their portfolio. So anyway, we'll keep our eye on that. But right now, what we're wondering about is, will we get a little bit of a bounce up and off of that rising 30-day moving average for TLT after a pretty aggressive sell-off the last 2 or 3 days? In the lower left-hand corner now, we do have our U.S. dollar, and remember, that influences a lot of stocks and commodities and other types of financial assets out there as well. And U.S. dollar was something that we were on quite early, right? We were talking about this breakdown the entire way. And the reason that we were talking about it is because it kind of flew into conflict with what we were seeing with TNX. TNX was not necessarily confirming the bearishness early on, even though it is now. We can see that in hindsight, but it was really the dollar that led the way down first, and then the TNX or treasury yields followed the dollar. A lot of times earlier this year, they had followed each other kind of in unison, but there was almost like a delayed effect this time around. So this is not anything that is new, other than to tell you that the same thing holds true. The dollar is still struggling. We just hit multi-month lows on the dollar. So if you were planning on visiting Europe, I remember we were joking about this a few months ago, the dollar was just red hot at that time. That would have been the time to go. If you're visiting Europe now, unfortunately you miss the sweet spot there. You're not going to have as many, as much currency to shovel around and do your part as a good American in spending your money across the globe. Just joking, of course. But nonetheless, dollar is in a bit of a downswing right here. But we shall see. We do have what's known as an oversold cluster signal on the dollar. We've had quite a few of those, as you can see here in the last month or so. And from my eyes perspective, it does seem like we do have initial bounces off of those oversold cluster signals. Again, if I right click and maximize the chart, you can see that these dots on the chart line up with the dots down below in the market forecast technical indicator when the blue, the red, and the green lines are all in the low reversal zone at the same time. So back here, in November, we got a couple of these dots, and that was followed by basically a 1-week rally to the upside, right? Things had gotten oversold. That was corrected by going higher. and then we fell again, and we sold off too much to get another oversold cluster, and for the next 2 days after that, we got a rally. Then we sold off again and got another set of oversold clusters, and we did rebound the next 2 days after that, sold off again, got another cluster, rallied for 2 days after that, and here we are yet again with another oversold cluster. So could we have a 2-day rally in store for the US dollar in the next couple of days? Yeah, it wouldn't be entirely surprising, right, based upon what we've seen here. They haven't really stopped the primary trend, but remember what I've always said. That's not my expectations when I see these oversold cluster signals. My expectation is not that they are all of a sudden going to go from being in a downtrend to being in an uptrend. My expectation is that the selling that got them into that condition will not be repeated at the same pace in that same period of time afterwards. So in other words, this 2-week sell-off that led to these oversold cluster signals is unlikely to be repeated in the next 2 weeks after that at the same degree, right? And so that's kind of what you're playing, which is why oftentimes you'll see me use these cluster signals not as a place where I am trying to make my, draw my line in the sand and, say that I'm going to buy this stock here and I'm just going to watch it rip higher or anything like that. I usually sell puts when I see those oversold cluster signals because it provides me enough wiggle room where I just have to not be horribly wrong with my strike selection, and I can still end up making money because the chances of it continuing to sell off aggressively are slimmer once you've already received the oversold cluster signals, right? So that's kind of the mindset there. All right, when the dollar is weak, oftentimes we have buoyant prices in commodities, and that was the case today. You can see gold was up 1.66%. In fact, I'll be talking about this a little bit later in our trade application example. You guys have been hearing me chirping for weeks now about my expectations out of gold. I think it was just this last Thursday when I was with you last where I said my expectations for 2023 is that gold has a pretty good chance of outperforming oil next year. That's my guess. I don't know if I'll be correct with that, of course, but that's my hunch right now based upon this philosophy that I've been sharing with you ever since basically the first week of November, where we saw this massive move higher in gold and we got so far up and off of that moving average that any natural pullback after that likely would not have put you back into that downtrend that had existed prior to that. It was just too aggressive of a move. And therefore, this is one of the rare charts where you clicked from being in a downtrend to being in an uptrend. Whereas with oil, I'm not as enthusiastic about it. First of all, we had a lot more bullishness out of oil than gold earlier in 2022, so they might have maybe overstayed their welcome to a degree. But in addition to that, you can see that despite being up today, not nearly as much as gold, only 0.23% for oil, and having a green background color telling us that we've got a bullish posture, you'll notice that the chart does not look all that good. This was an aggressive move lower to these oversold cluster signals. We're now in the process of that dead cat bounce type of a phenomenon, but we haven't actually broken the 30-day moving average. So right now, my assumption on oil is that there's a greater likelihood of selling in oil moving forward than what we would expect out of gold, right? Because they find themselves on either side of those 30-day moving averages. So we'll talk about that a little bit more with our trade application on gold here just a little bit later. So I'll reserve my commentary for that. But on some of these other charts, be aware that EFA was up pretty nicely today. It did outperform U.S. markets. This is the foreign developed markets when I refer to EFA, and it was up 0.4%, and that often happens when the dollar is weak, as it was today. What was a little bit stranger is the fact that EEM was not up today, right? They are also foreign stocks. It's just that they are the emerging foreign stocks, things like China, Brazil, Russia, India, what have you. So there are different dynamics at play, and today you didn't really see that traditional relationship of a weak dollar pushing emerging market stocks up, but a weak dollar did push the developed foreign stocks up like we would have expected. Let's go ahead and take a look at our sectors now on chart 5C. And as we do, you can see that unfortunately we have a clean sweep of pink charts here, not a single green chart in the mix this time around. Again, these charts are driven by what is happening with the market forecast technical indicator, particularly the intermediate green line on the market forecast. So all of them are set up with more bearish postures at this moment in time. However, some of the charts you'll notice have this light pink color as opposed to some of the charts have the dark pink color. So as most of you are aware, the light pink colors are the ones that aren't as aggressively bearish yet. The ones that are dark pink are telling us that, hey, there's more concern with those types of charts. And as you can see, many of them are breaking down, including some of the most important ones that I had mentioned before. Communications, technology, and discretionary all have that darker pink shading. And you'll notice the Tesla effect happening on XLY right now. Notice that it's not just Tesla that's pressing into multi-month lows. Also, you'll see the same thing here out at XLY. And remember what I've shared with you multiple times here, especially in recent months. XLY is a market cap weighted sector ETF, and therefore basically two stocks make up a third of this entire ETF. Those two stocks happen to be Tesla and Amazon. And if I were to right click and show you, again, we saw how ugly Tesla was just today, but here's what the chart looks like on Tesla. Down 8% today and just in a house of pain. Look at all those red candles. There's hardly any black candles along the way. They're mostly red selling candles for the last 3 months. So naturally, when Tesla is one of the biggest components of XLY, XLY is going to struggle to keep up. And then Amazon's the other one that I had mentioned, and it's much the same. It's not quite as bad as Tesla, but both of them are in the house of pain, touching multi-month, if not yearly lows. And so with both of those two being the most important components within XLY, then naturally XLY looks like garbage as well. However, if you were to looking at an equal weighted version of RCD, it looks a little bit better. Even that started to break down. Up until this past week, it had been holding up very nicely. But this last week kind of went and nipped it in the butt there, and now it's starting to follow XLY down. But you'll notice that RCD, which is the equal weighted version of consumer discretionary, isn't anywhere near its multi-month lows, whereas XLY is already pressing into fresh monthly lows as we speak. So it is the bigger players within consumer discretionary that are particularly concerning at this moment in time. In terms of who the best performer today was, probably was energy. Let me just verify with my eyes. Yeah, it looks like energy was up 1.51% today. No surprise there given what we saw on the heat map just a moment ago earlier in the video, when we saw Exxon and Chevron and some of those up very nicely. So they had a one-day snapback there, but again, trading below that falling moving average, just not sure how much we can trust them despite a pretty nice day here today. And again, no surprise that XLY or discretionary was the worst sector here today, down 1.16% given what happened to Tesla. All right, let's go ahead and get into the trade application example now. And I'm going to use chart 3A for this discussion, and I'm going to pull up ticker symbol NEM. This is Newmont Mining. Gold miners have started to come into vogue here recently. In fact, I was looking at a number of gold miners for today's setup because, as I've mentioned here earlier, I've been keeping my eye on gold ever since basically November, and I finally said, you know what, enough is enough. Let's place a trade on it. And I looked at a lot of different gold miners. Unfortunately, there's not a lot out there, and of those that exist, very few of them have much in the way of liquidity. Most gold mining companies are outside of the United States. In fact, Newmont Mining is the only one, the last I checked, that was actually in the S&P 500. So there's just not a lot of opportunity there. You could always trade the ETFs, by the way, like GLD you could trade for the price of gold, or GDX for the price of gold mining stocks, the majors. GDXJ covers the juniors. But in this case, I opted to go with Newmont. But again, there's a lot of other pretty good-looking bounce setups out there as well. If you look at GOLD, which is Barrick Gold, you'll notice the same type of formation where we're bouncing up and off the moving average. If you look at Agnico Eagle, it's doing the same thing. Nice uptrend in place, bouncing today. If you look at Royal Gold, which is more of a gold royalty company, you're bouncing up and off of that moving average. If you look at SSRM, this is SSR Mining, nice little bounce up and off the moving average today. And also AGI, which I had never really heard of before today, Alamos Gold, had a nice move up. But many of those are more speculative. They don't have the options liquidity to actually place spread trades. So I opted to go with just the good old Newmont Mining, which has been around for decades and decades and decades. I've drawn a line here to identify what it is that I did with this particular trade. Naturally, I'm looking at this more bullishly given my expectations out of gold, and just looking at this chart clearly making its way higher over time as opposed to a lot of stocks really selling off here in the last couple of weeks. You also have what appears to be a little bit of a bullish near-term divergence signal. You'll notice that we have this near-term blue line in the lower reversal zone here, and then the follow-up trough to that is basically right on the outside of that lower reversal zone. So in other words, higher highs on the underlying indicator, or I should say, let me take that back, it's higher lows, because this is a low, this is a low. So higher lows in the underlying indicator, and then the two levels associated with that from a price perspective is this candle right here and this candle right here. So obviously price went down at a time when there was an improvement in the underlying indicator. So that kind of helps the cause. It doesn't have to be the primary reason for taking a trade, but nonetheless helpful to have one more excuse, I suppose, to take a paper trade like this as a trade application example where you're clearly seeing a bounce up and off of the moving average. Moving average has now turned green. The background color of the chart is now turned blue, identifying a bullish near-term posture as well. So what I did was I sold a February 45 to 42.50 bull put spread. And so I got a credit of whatever it was, and so my break-even price would be 44.38 in this case. So I want this stock to stay above 44.38 between now and the middle of February. That was one thing I wasn't as enthusiastic about. It kind of feels to me like this break-even was a little bit tighter than I preferred. Nonetheless, I think the setup is actually a reasonable one. I was halfway thinking about just doing a normal stock trade as a swing bounce trade, but as I mentioned to you previously, I'll be out of town for many days next week, and therefore I won't be as able to be glued into the paper money accounts to be able to report upon any fills that are done along the way if we hit our target price or our stop loss or what have you. By doing a spread trade like this, it allows me to be a little bit more calm and stay with the trade for a little bit longer time there as well. But I do think it would be a reasonable bounce setup for a normal stock trade in this case as well. Okay, so that's what I had for you. If you enjoyed this trade setup or the previous commentary in the presentation, I ask one simple request out of you. Just simply click like for me there on Twitter. It'll only take you 5 seconds and doesn't cost you a penny. If we're up and over 100 likes by the time I'm scheduled to do the video again on Thursday, I'll give you another full-length one like this. Otherwise, if you prefer the shorter 15-minute variety with no trade application example, then don't click like, and we can go that direction as well. But Thursday will be my last day this year for this presentation, so keep that in mind as well. So, hope you enjoyed it. Thank you for checking it out. I hope you have a wonderful evening. David should be back with you tomorrow, and then I'll see you one way or another on Thursday. Until then, best of success with your trades and your investments. Goodbye for now.